The doomers are wrong again. The U.S. economy added 130,000 jobs in January. That was double Wall Street expectations. The unemployment rate ticked down to 4.3%. That is the best monthly gain since December of 2024. Is the Trump economy finally taking off? Welcome to the Big Money Show, everyone. I'm Jackie DeAngelis, along with my co-host Taylor Riggs, David Asman, Brian Brenberg, and with us for the hour, Michael Lee, strategy founder. Michael Lee, thank you for being here.
Thank you.
This wasn't a close call either. The forecast beat 79 out of 80 estimates. Strong jobs numbers also mean that the Fed stays in its holding pattern, though, which is why we're seeing some of the red that we see on the screen today. President Trump telling Larry Kudlow that investment equals growth, growth equals jobs.
We have $18 trillion invested in this country. Nobody's ever had anything like it. We haven't. When I say nobody, it's not even close. Not even close. I think the record is $3 trillion. We're at $18 trillion. And, you know, they talk about construction jobs are way up, right? Well, they're up because they're building all these factories all over the country.
So is this a resilient economy or a labor market that's strong on the surface but tightening underneath? And it's really funny, Mike, because I was talking to a couple of experts who said they were expecting this jobs report to buck, you know, sort of the trend that we've seen and be stronger, and that labor might not really be the place that the Fed can hang its hat if it wants to lower rates. What are your thoughts?
Yeah, so this was an excellent report. Take a step back, though. I don't trust the BLS labor report, right? We've had like 24 out of the last 26 months have been revised lower. And we had these series of, during the previous administration, where you would have a headline number that beats estimates only to be revised by the third revision to be lower than the initial estimate. You know, something like a 11 or 12 standard deviation when that happens 10 times in a row. So, like, I don't know what's going on in the Bureau of Labor Statistics. I don't really trust a lot of the government data. First, it's hard to collect data. But second, with the way the economy is changing and the way they collect this data, it's survey data, right? So you're using the phone to call employers of 50 or more people, and you have a rolling sample of 50,000 people throughout the year to judge a labor force of 165 million. Okay. That being said, if you look at the ADP and all the other, and the JOLTS, this kind of jives. Like, we get a little bit of a spike here, and I'd say the ADP probably looks a little bit dour to what we're seeing in the GDP reports. And I don't see a labor market that's exploding the upside, but I clearly don't see one that's falling off. I think the good thing here, though, is the wage growth. What were we, 3.7% year-over-year growth?
0.3 per month.
Yeah, and so you compare...
0.4, excuse me. It was expected to be 0.3. It came in at 0.4.
But if you look at that year-over-year, like, where inflation was like 2.6, 2.7%, you're gotten like a 1% real wage growth. That's the type of numbers that we need to see over and over. And I tend to think that with this AI, you're going to start to see a labor force reorganization. You're going to start to see a lot of job tightness and wage growth in the trades industry as we really start building out these data centers over the course of the next 12 to 24 months. And then manufacturing really start to kick into gear with the effects of the big, beautiful bill, endangerment finding going away yesterday. So I'd expect this labor force, this labor numbers to get much better. And then as you tie that back to the Fed, short-term rates are coming down. If you follow Trueflation, E.J. Antoni, who should be running the BLS, is a big proponent of it. Scott Bessett was discussing it this weekend with Maria. Okay, they track 1 million real-time data points. They're tracking year-over-year inflation around 1%, not this 2.6, 2.7. Okay, so inflation and the government, historically with the way Trueflation tax and the government data, they're 6 to 9 months ahead of it. So we should see a material tick down in government inflation numbers. So I think that's going to clear the way for much lower rates over the course of next year.
Okay, we have talked about the labor BLS, the reliability, who should be running it, what should happen. But the truth is, Brian, this is the only data that we have. And the market does react to it. It not only reacted to the upside when the numbers seem, you know, is strong, but then Mr. Market always processes everything. It thinks about what the Fed will do with this, and it says, oh, this isn't going to make the Fed enthusiastic about cutting. We love our sugar high, you know, keep that punch bowl spiked. So here we are right now. If the labor numbers continue to bounce along the way Mike is saying, maybe they're not home runs every time, but maybe they're not terrible either, we stay in a holding pattern.
This is why we got to fix the Fed. I totally agree with your analysis. Like they're hanging on this number, and markets are moving, and maybe the Fed minds are changing. But I'm totally with Mike on this one. I don't know what to make of this number. I really don't. Like 130 is a good number. Beat expectations. I have zero confidence it's going to be anywhere near 130 3 months from now. I just don't. It's going to get revised. Last year's 2025 numbers, we had 584,000 jobs created last year, okay? That number got revised down to 181. Okay, that's a wipeout of the jobs we thought were created last year. Then you go to the household survey, which we're not even talking about, different survey. That showed the number of employed increased by 528,000. Mm-hmm. And the number of unemployed decreased by 141,000. So you tell me what those numbers mean. So what I'm saying is we've got a Fed right now. I think that they do hang on this stuff. This is what Kevin Warsh has to fix. And Larry will probably talk about this in the second hour. They got to have a different set of metrics to look at if they're going to figure out where monetary policy should go, because I don't think these jobs numbers tell us the story. And if you just went by this number, 130, you'd say, oh, rate cuts totally unnecessary in 2026. Right. I do not think I agree with that, in part because of what you just said about the trueflation number, which is not BLS data. That's somebody else doing that number crunching.
Okay, well, let's assume we stay where we are. Let's assume we don't see, significant rate cuts, but the market is looking at maybe two. Taylor, you've been talking about wage growth. The wage numbers are good.
Yes.
Even if we stay where we are, people are seeing an improvement. So if you start to get some kickback into your household from the big, beautiful law, and your wages are going up, inflation has steadied, tariffs haven't been a huge impact, then it's not so bad.
I totally agree with you. And for that point, Jackie, I'm going to disagree a little bit with Brian that with all of these payrolls, you could put a little bit in a revision and pull some of it down. But this was double the estimates of some people. Listen to a note that I had this morning before the numbers came out. With immigration trends shifting dramatically, a 75,000 payrolls print, if we get that, should be viewed far more positively than in the past. And we got double that. So can we take a little bit away from some of the revisions that we'll get a couple months from now, Brian? Sure, but I am not going to dismiss all of these numbers that look so good that are coming in. So with the 170,000 in payrolls in January, Jackie, the momentum in employment, even with benchmark revisions factored in, now shows no deceleration in the labor market. The 12-month average private payrolls is 51,000, 6 months, 62,000. The 3-month change, 103,000. And the Fed just took out a 75 basis points insurance cut. All of that factored in. So some of the notes that I'm reading this morning that I really like show that there is no real basis for a rate cut in March. And actually, maybe there's more upside risk to inflation than there are to a slowing labor market if we are thinking about wage gains and how that really sets the consumer up for success. We also talked about the retail report yesterday, and I think those are so volatile that I'm just not quick to believe that either. I was reading another report this morning from Bank of America, and I've cited this report because in your checking account, they're able to track whose money's coming in and what they're spending on within the credit cards. Total credit card spending is still up 2.6% year over year, showing massive, solid resilience in January.
Okay. David, you were shaking your head at something.
No, I just don't buy the fact that we're going to have this uptick in inflation. I mean, we heard all of the phantom stories about inflation and tariffs, and they never came to be true. Even Powell admitted that in his last statement. Remember his last presser after the numbers came out, and he said, no, I don't think that it's going to be a problem. So if even Powell is admitting to that, I just don't buy the inflation business.
And I don't think, let me correct, there's massive inflation coming. But if we're balancing the risks, the risk is more about inflation than it is about a slowing labor market.
I disagree. I disagree entirely because of the fact that the economy is growing so strong. And that and the productivity is through the roof, our increase in productivity. And the one thing that all economists agree on is you increase productivity and you you'll have lower inflation. The
But then there's no
on
labor
less
market
inflation.
problem.
But I want to talk about another phantom, which besides the phantom of inflation and tariffs, which is the phantom jobs, which is what, again, we are trying to work through. Mike, I think that's part of what you are seeing in the dysfunction of some of these labor statistics. The last 2 years of the Biden administration, we had 1.5 million phantom jobs in 2 years. 1.5 million, because there were so many things going wrong. Part of it might have been the pandemic that led to a lot of dysfunction. Michael Faulkner's talk about that. But again, there was a lot. These are slipdash figures. The one thing I think we can rely on, first of all, the wage increase is tremendous. Workers are finally getting ahead of inflation. That's a trend that we notice now, that workers are in 2026 getting ahead of inflation, and that's a great thing. That's something the president should mention at his State of the Union, by the way. I think definitely. The other thing is we're moving away from government jobs into private jobs. We were expecting, about 47,000 we had 100,000 more private sector jobs than we were expecting. I think we got a total of 170,000 private sector jobs. We were expecting about 70,000. The government jobs went down about 47,000. We're moving in the right direction as far as that concerned. We want more people working in the private sector and fewer people working in the public sector. And that's another good thing that I think is reported.
I just want to jump on your phantom jobs thing, though, and this is kind of pushing back against you a little bit, Taylor. Just to be clear, yes, under Biden, tons of phantom jobs. But the BLS today said last year they recorded 528,000 jobs. When they did the revision, that became 141,000, which means 75% of the jobs we talked about last year were phantom jobs, according to the BLS.
I know,
So
I'm
all
just not going to
is
dismiss 170,000 private payrolls.
But here's my thing. But here's why I would be careful about that. Because if the Fed looks at that and says that's our key for interest rate policy, that would be a huge mistake, in my view, given how unreliable that data is.
So this wasn't a good jobs day?
It was a great jobs day.
Taylor,
It was a great
I
jobs
want you
day.
to be right, but I got to look at the data these guys put together, and it is like horseshoes, and they're not even getting close to the stake right now.
All right,
there are
speaking-
things we can double check, like wage growth, and that are not subject to some of the skepticism. And I think your skepticism is well placed. So is yours,
faith
Mike.
in the
But I
BLS
think there are some things about this report that can be clearly celebrated by all of us.
Speaking about the markets, I always find the phenomenon of the pop and then the sort of think it through and the reversal really interesting. Meanwhile, Taylor, you're watching Bitcoin today.
Yes, Bitcoin, and I'm going to tie that in with shares of Robinhood. So Bitcoin, wow, is all the way down to 66,000. Remember, Jackie, I think last week I said if we break through 76,000, you were going to start to head south to 45,000 on key technical issues and a lot of deleveraging that's going on in the sector. That's what technical strategists are saying. So that's Bitcoin. That also folds into Robinhood earnings that we got as well, because a chunk of their revenue comes from crypto trading. So the shares are down 12% because basically the brutal sell-off in crypto was hurting the top line of this company.
If it dropped to 45,000, Mike, I would be buying.
I'm a buyer here.
Okay.
I think if we enter, so if you look at the historical trading patterns, this should, like, in theory, we have entered a crypto winter. And in that crypto winter, like, your near-term low, or kind of, we should head to like below 40, to like 37, 38,000 should be the next stop if you go according to kind of the historical pattern of all the reversals. But we never really hit the upside in this last segment. So we should have tripled the 2021 cycle high and gotten to 180, 200,000. We never got up there, and I think a lot of that had to do with the government shutdown. And then if you look at the various things that have happened this year in like the software Mageddon or the SaaS apocalypse that we got last week, a lot of these tech stocks are fellow travelers, and it's that you have common ownership in between them. And so when someone's getting a margin call on their SaaS stocks, they're selling Bitcoin too, because look, in a risk-off environment, You're selling what you can, not what you want. And so a lot of time, you may not necessarily be selling, you may be getting liquidated, right? So you get this avalanche. So it remains to be seen. If we see a sharp reversal in these AI names, Bitcoin could be back off to the races. So I'm not 100% convinced that this is the end of this kind of near-term cycle with Bitcoin, but we'll see.
Okay, I agree with you. I think overall, when we look back long term, this is going to end up being a blip before we move higher, but we'll see.